to do is introduce our two nicely dressed gentlemen here. Rob van Schimmelman, known Rob a very long time actually, considerably longer than he's been working at AgileAssets, interestingly enough. First met Rob, I think, down in Florida.
That's correct.
Working for a different company, and tracked him all these years through many years, and well, not many years necessarily, but a number of years in Ethiopia, right?
Mm-hmm.
And it was really great to have him come work for AgileAssets. I think he's been working here for about 4 years.
That's correct.
And Himanshu Waikar, also a long-time friend. Drank a bit of whiskey together over the years. And I think
non-alcohol.
I see Steve up there. Himanshu and I work very closely out in Idaho. The original projects out there in Idaho. Steve Spoor there. And I think Himanshu's been with us 8 years. So what we're going to do this afternoon is, these two gentlemen, as I say, are both MBA students currently, going through the MBA program here in Austin, Texas.
That's right.
There you go. And so what I really wanted them to do was take us through a little bit of an exercise to really start thinking about some of this stuff in a completely different way. So, you know, they're, as I say, MBA students. They go through a lot of these kind of exercises all the time. And the idea here is just to kind of inject something new. So it's a really good, a good kind of exercise for just getting the juices flowing, getting people thinking, both our folks and our client guests. And so with that, I'm going to turn it over to you guys.
All right. Thank you, Charles. Well, thanks for the introduction. I am, of course, Rob. We approach this as MBA students, and so we really approach this the only way we know how, and that's with being vague, having answers that end in "it depends," and also calling on you guys, because this is right after lunch and we don't want anyone falling asleep. This is very interactive, so we appreciate if you guys have any information to volunteer, that you chime in. We're going to go over why you want to bother with the asset investment entirely as the portfolio itself, your role in making that investment, tools to help you manage those, and then a case study. So this will be where you guys group up, and we're going to give you a very, very simple case, a very vague case that you guys can start brainstorming on and come up with your own ideas on. And then at the end, if we have time, then you can share what you have or any other questions that have come up. So with that, why? Why do we care about investing in our assets? Anybody? This is the interactive part.
They're very expensive.
They are very expensive, yes.
They provide great benefits and value.
That's correct. They do provide great benefit and value. Anyone else? I'm sorry? Yes, our society does rely on them. Indeed. We have a few items here because they cost a lot, yes. And what do they cost? Well, from a financial standpoint, they cost the present value of all current costs, so everything that it has cost you up to this point, plus any future costs that it will be. So anyone who is familiar with discounting would know present value of it is associated with figuring out what in today's terms dollar amounts are for future events. So normally what we would do in this case, Himanshu and I talked about it, it would be a treasury bill. We would take the percentage rate on that and discount over time any cash rate over those numbers of years. And then of course, the ultimate goal would be to extend the life of that asset. So I'm hoping that everyone would want to be doing that, hopefully. I see some no agreement, any agreement? Hopefully, all right. And with that, I'm actually going to turn it over to Himanshu to talk about some of the, it's listed here as the efficiency frontier, but kind of go over that when you are investing in these assets, because they are so much, because they are so important to you, kind of a decision-making tool that is used in finance and also for other reasons as well. So.
Thanks, Rob. Good afternoon, people. My name is Himanshu Waikar. I think most of you know me, I think. When we asked the question, you mentioned cost, you mentioned benefits, and you know, there's value. So there were two main aspects of it that comes out, and I think if everyone wants to answer like those questions on why we want to do this, the real takeaway is there is a lot of value in doing it, but it comes at a cost, right? So those are our two main implications of this action, of when we are trying to manage any asset, right? Not just any physical asset, but you can take it to any industry, any business world. And when you're talking of investments, those are the things that we talk about: value and the cost, return and the risk, right? Your utility and your cost effectiveness, right? So, when we talk about efficient frontier, one of the things that you see in investments when you manage your portfolio, for example, your 401k, for example, what you see is you have a different mix of asset classes, right? It's very similar to what you have in your real world right now, in terms of pavements, in terms of bridges, in terms of any other asset classes. You have your return in here, which is in terms of dollars. You have your risk. We'll talk more about what this means. And you come up with different portfolios, if you will. Right? So think about when you are making an investment choice. Okay. So think about when you're making an investment choice, when you are trying to put your money into stocks and bonds, for example. Right? So you come up with a portfolio mix. Same thing here. When you're trying to put money into your bridges, your pavement, you'll try to come up with different portfolio mix. And each of those mixes will have some return and some risk to it. Right? And we can plot those in this graph. So this can be one combination. There can be another combination. We can come up with all sorts of various portfolios here. And what you realize when you look at this is there is a better choice when you try to pick a portfolio. There could be a better choice than that. So for example, if I look at this one here, this one has less risk compared to this one. This one has less return compared to this one. So of course this is better. This is a better choice. But when I try to look at this versus, let's say for example, there was another one here. This one is better than that portfolio mix because it has lower risk for the same return, right? So you will notice that when you're looking at all of these portfolios, there is an efficient frontier where you should be targeting for. So for any given return and risk, you should always look at what's the best value that you get for the same amount of risk that you take, right? And this is your efficient frontier, where every portfolio mix on this efficient frontier is better than anything that's underneath it. There's a full theory that proves this, but that's the gist of it, that you should be looking at your efficient frontier. Now, this can also be translated in different forms. When you're looking at operations, you can say, okay, I have my responsiveness, and I have my cost effectiveness.
Might want to move that a little bit
Oh.
so you can see.
And the principles are similar. You'll just get different forms of efficient frontier. You can have high responsiveness and low cost effectiveness, and so on and so forth. There can be several mixes over here. And the efficient frontier in this case looks something like this, which has again the same principle. You can pick up any business problem. You can pick up any industry problem. You can pick up your transportation asset management problem, and you can come up with your own efficient frontiers. The challenge everyone has is how to get to that frontier, and once you're on that frontier, how to improve that. So you're constantly trying to improve, and you want to create a new efficient frontier where you can come up with something which is even better than this. So that's the idea behind the efficient frontier. You look at all sorts of inputs in there. You look at your utility. You look at all your requirements in terms of the cost. You look at your safety, so on and so forth, and you come up with your own efficient frontier for your scenario. Rob?
The only thing I'd add to that is, why is this important? So we've got risk and return. So there are definitely risks for not doing an investment. However, in your guys' case, since in everyone's case, we don't have an infinite amount of money, and so therefore we have to make choices. And so the idea behind the efficiency frontier is that you are getting the best bang for your buck as you go along. And that, again, as Himanshu stated, could be risk versus cost, or return versus asset condition or life or overall. And again, as Himanshu pointed out, definitely a way to help with this is if you keep your network up, so the condition rating up, theoretically it should cost less to maintain it at that level. But that is definitely one thing that can be looked at. The next item that we had kind of tagged as why is this important is because you guys have mandates. Whether they're funded or unfunded, they must be done. And so that definitely plays into items, whether that's just the safety or some other means. It becomes very important that you guys have to do it, otherwise there are consequences involved. I don't know if you wanted to add anything to that.
No,
Okay.
actually it leads to the next part very, very well, which is the
Yep.
risk management. And the term risk is usually something that's, I'm not sure how clear I was until I took some of the classes in the MBA program. Risk is, how do you define risk? Let me ask you guys. You guys have been sitting there trying to.
The chance or the uncertainty that something will go wrong.
Yes, that's definitely the risk definition there. And more importantly in risk, what happens is you don't know if it's going to happen. That there's absolutely no reason why Austin will be hit by a hurricane. But it can happen, right? There's something that is possible. There's a low probability of it happening, but it can happen. Right? And when it happens, the impact is high. So if there's 1 to 9 odds, your payout will be 9 to 1. It's that kind of a principle there, right? So when you're talking about risk management, this is where the risk comes into picture. When you're talking about your mandates, 5 years ago, if you were not planning for that, or if that was something that was in the making, and you know that it's coming, but you don't know how it's going to be defined, that was the biggest impact that could have on your budget, right? So some of the mandates, if they are not funded, and you still have to comply with it, now, if it's in front of you, how do you deal with that? That's your risk right here. Now, risk combined with variability, and what I mean by variability is, variabilities are the facts that you know are going to occur. You just don't know how. So when you're doing a road construction, you know it's certain activity takes 3 days. You don't know exactly it's going to take 3 days or not. It could be 2.5 days, it could be 3.5, it could be 4, 5, it can vary. You know there is some variance in it, but you don't know exactly how much. But it's going to happen, it's a fact. There's no doubt about that. So risk combined with your variability is your uncertainty. And the biggest and most important, of course, is safety, where everything is high. Your variability can be too much. You don't know if what kind of damage can an accident do to a bridge, and you don't know what mobility factors could affect your network use. So risk management in terms of uncertainty, variability, all these things you have to take into account when you're talking about coming up with the most efficient portfolio. And by portfolio, what we mean is what's the best that you would get out of a certain investment, which is how much investment do I put into one asset versus another asset class. Any questions so far? Nope. All right.
I actually want to open it up to you guys. Do you think that there are any other reasons, now that we've got the ball kind of rolling, why we care. Why do we want to diversify? Why do we want a whole portfolio? Why do we want to view all of our assets as a whole rather than individually? Please.
It affects whole-scale funding decisions that are made by the department.
That's right.
You have a funding split between pavements and bridges, for example, so you want to know what your optimal conditions will be when funding goes forward.
That's right. Because for the recording, because of the funding impacts of combining all the assets. Anyone else?
It's important to note here that each one of these, it's not just one asset type that is dominated in here. It could be that you're putting most of your money into bridges, for example,
Yeah.
because it impacts the safety the most. It's important to note that the idea behind having a portfolio is so that you don't risk all your budget into one asset investment, which is the same across your financial investments as well. Hopefully that makes sense.
Would you say that the return there could be not just measured in dollars, it could be various different types of return,
That's
different objectives, essentially?
That's correct. And yeah, what Charles mentioned was the return doesn't really have to be just in terms of dollars. It could be anything. And think about a utility function. At a personal level, when I'm trying to invest in stocks and bonds, I know what makes me happy. I know how much return I'm expecting for a certain amount of risk. At your level, at the agency level, it's a big decision. And it's not just about happiness of one person versus a group of people. It's about safety. It's about providing the value, the benefit to the society. And there could be different utility functions from one geographic region to another, from one DOT to another. What works for Idaho may not work for New York. What works for Idaho may work for New York as well. There are so many different levels of utility through which you can measure your return.
It's
Charles?
a quick show of hands. Has anyone not heard of utility? Is there, who knows what utility is in the terms that Himanshu's talking about? I know you know one. So yeah, maybe just
Can you give me-
maybe just give everybody a quick definition of utility.
Okay.
So utility would be, like Bill was saying, it's a level of satisfaction. That's the simplest way I could define it, as it's a level of satisfaction. And when you go to the doctors, when they ask you, okay, do you have a pain? Yeah. On the scale of 1 to 10, how much is your pain? Well, I can say 9, but my 9 could be much lower than your 9. You might have experienced a whole lot of pain before. Same thing in terms of utility, is it's about the value that you're providing back to the society, right? So if you have a utility function and you have a certain way to measure it, it could be you can have various inputs to it, like
Some of the things that Stuart talked about in his keynote address, actually.
right.
A nice long laundry list, actually, he gave us like that.
So exactly. So you can have your own way of coming up how you define your utility, and what's the action that gives you the most return, so that provides you the most utility on that.
Yeah.
Anything you want to add, Rob?
Yeah, I would just say that it's normally a bunch of input factors that have some form of weight on them to show the importance of one perhaps over another. So if in case safety was the primary concern, in any kind of utility function, you would put a higher value on that as you then run inputs through.
If you have any doubts, question, we can always chat about it at the cocktail hour.
Yeah.
Utility increases.
And utility increases,
Yes.
that's right.
Derek, do you have a question?
Yeah, well, just a general comment. And when we're looking at multiple assets, so for instance, when we're doing desired level of service, in that case, we use a utility where we're almost handicapping how much we would seek to improve any one of those elements. So, for instance, if you're looking at a scale of 1 to 10, you may not want to go above an 8 on a particular item. So, for instance, you may have mowing. It's all well and good to have an overall score which is high based on doing a lot of mowing, but there's only so far mowing can take you, right, before. So you basically say, if I'm at an 8, start looking at other things. Treat it as if you have achieved that 10. Start looking at the pavement and these other things before you come back to finish that one. So that would be the utility function in that case.
No, excellent point, and which ties back very well with the whole idea of having a portfolio. Is you can get only so much out of investing into one type of asset, one type of activity. At some point, you have to start diversifying it, and diversify in terms of not just the same asset class, but across asset classes.
And for those of us on the recording that didn't hear what Derek said, I will let you ask us later, because I can't paraphrase it. All right. So next, really, who should be concerned about this? Who should be implementing it? Should be a pretty straightforward question. It should be us in the room.
Well, not me.
Well, yeah. You should be helping them make that decision.
That's right. That's right.
So
That's what we're here for.
you as decision makers, as managers, are the majority shareholder, if you will, proxy for decision making. So the public would be the overall body of, in a business, shareholders, and you guys are acting on their behalf. So you are looking to maximize the benefit to them. And then investing in transportation assets, it's not just a portfolio manager, but you do own them. So you guys are making decisions, and you also have the ability to enforce it as well. Anything else you want to?
No.
All right. So now we move to how.
How? Yeah. So that's an excellent question. How do I get to this point? This is all well and good. I understand what you guys are saying, but how do we know what is the right mix? How do I get to that point? Well, the answer is I don't know, and the answer is it depends. The answer is there is no one right answer. That's the right answer there. Which is, wouldn't it be awesome if we all knew what the future is going to be like, right? If I know that a certain acquisition is going to happen, I'll go buy more stock for that company, right? So I can make a whole lot of money. Well, if I had that information, I couldn't do it because it would be illegal. But that's the whole idea behind not knowing things, is I just don't know what's going to happen in the future, but I can do my best to identify identify the scenarios, identify what might happen, because there are certain things that are under my control, under your control, which is you are given the budget, you have to take care of the activities, the upkeep of the assets, and so you know what your assets depreciation is like, and you know how much of treatment you can do to an asset that will change its health. So, using the forecasting models, using your the tools at your hand, there's a great tool, portfolio analyst, right there. You all know about that. Using all these tools is getting you closer to the ideal answer. The point is not to have the perfect ideal answer to the problems. The point is to have enough information, the right information, to help you make the smart decision.
Yeah, the only thing I'm going to add to that are asking what are these forecasting models. Most of you guys already know pavement is one of the big ones. It's a degradation cycle. You have them for pavement, you have them for bridges, you have them even for fleet. So you can utilize those and put weight factors on each one to utilize. In terms of managing the portfolio, really what we're saying here is that this shouldn't be a static thing. This should be something that you're revisiting as often as you need to, as often as you can, as factors do change. Diversifying, we could go into a long spiel about how wonderful it is to diversify, but I think we all know just intrinsically that diversification is better than putting all your eggs in one basket. So with that, I'm going to move into the case study. So we had our first person to leave because he was afraid of a case study. But we added one, so we've netted
Welcome,
the same.
sir.
And so for this, what we would like you to do is to group up with someone who's next to you, one or two people. That's why we gave you the paper and pen. We want you to remember that there are no right answers here. We have not given you any kind of real basis to make your decision, so this is all kind of your own thinking coming on here. And you are given a scenario where a Department of Transportation has 5 assets, and the strategy is to spend all $500 million that they have. Currently, in their fiscal year, they have it allocated 40% pavement, 30% bridges, 10% signs and signals, 10% culverts, 5% guardrails, and 5% sidewalks. So they don't have a whole lot of diversity in their assets. This is what they have. And the questions we want you guys to think about in your group are, should they use a different strategy than what they have? How much will you save or gain by a different approach? And that's kind of a loaded question. If you were to have more budget, what approach would you choose and why? How much more would you need, or how much would that cost? And what additional information would you like in order to actually solve this? So we're going to leave it open for the next about 10 minutes for you guys to get together. We'll wander around for any questions.
Just to add to that, it's important that you answer the question why.
Yep.
So that's where the real meat is. Try to answer the question why you would make a decision.
Yep.
So buddy up, guys, and we're going to have presentations at the end here. Guys, having fun?
under there. I'll put it under here.
Okay, 2-minute warning. Re-adjourn. 2 minutes. Okay, folks, 2 minutes, and then we're going to wrap it up and ask volunteers to present. Two teams.
You got 2 more minutes.
Although we did fail. We're gonna give you some more assets, like 5 is before. No assets.
We will buy more ice cream.
Alrighty, guys. So let's bring it back. You've had some time to think about this, and now comes the big reveal.
And the big reveal is
We want 2 volunteers to bravely come up and share what they've discussed.
all right.
Anyone?
Who's the first volunteer?
We
Bill?
can- All right. Bill?
Thank you very much. Hi, coming live from Agile Assets. No, one thing that's really missing here, so I'm going to start with the end question. One thing that's missing is condition data. I mean, what can we do without condition data? So we made some assumptions on condition data. The assumptions that my team made was that the pavement was relatively new. It was in really, really good shape. So incrementally, you don't need to spend that much to maintain it. However, your bridges you've been neglecting for 15, 20 years are in very, very bad shape. So we swapped the 40 for 30, if you will. And since the pavement was in great shape and you have new roads, you need more signs. So you spend a little bit more, 15% in signage, because you got new roads. You want to make sure people understand how to get to the new roads and get to where they're going. And we left culverts the same, and we left guide rails the same, and we starved sidewalks, because we don't care. We're talking about pavement here. So that was our rationale.
Okay.
Thank you.
Thank you. And so a follow-up question to that, how do you think that going forward that this would help the agency by changing this?
Well, by doing it, by couching it into the situation where you have to deal with the conditions, you've got to now think qualitatively, and you've got to reduce the qualitative thinking into numbers, and the numbers then can be put into an analytical machine where you can then draw out the optimal result.
All right. Thank you. Anyone else?
Thank you.
Any questions
Thanks, Bill.
for Bill and his team? Well, we don't get volunteers, we're going to nominate.
Yeah.
We win.
All right.
All right. Come on up here, sir.
Somebody who actually knows something.
Thank you very much, Doug.
Doug McBroom, Montana Department of Transportation. So in order to do this, the first question is, should we have a different strategy? And I worked with Steve from Idaho, and the answer was a resounding yes. If you're doing straight budget allocation like this without any idea of condition, that's a silly way to invest. Although if I was investing your money, I certainly would do it that way. Thank you. You're welcome. Number two is, how would you save and gain with a different approach? Again, that's a really difficult question to answer. But like your example, if pavement's in a good condition and we're spending $200 million out of our budget on that good to excellent condition, you might get a 1% gain in your pavement, and I'm not sure that's a great investment. So you've got to find the biggest bang for your buck, or so to speak, or gain in utility, to use your vernacular. So what would, if you give them more budget, what would you do? We would use a very similar approach to what we talked about in the first, which we need to know basically three things. One is the current condition, two is our degradation cycles of each of the assets, and three is level of service functions. If you know the level of service and investment function with those other three, you can make a good decision. And essentially, one way to think about this is the algebra hell that you all went through. We've got 5 equations, 5 unknowns, solve simultaneously. That's it. And then the condition, what additional information we would want to know, obviously, those 3 things. Current condition, the degradation cycle, and the investment function.
So Doug, I have a question for you. Can you maybe explain that investment function a little bit?
You thought you were free.
What do you mean by that exactly?
Well, there's a investment or a cost to improvement ratio, and it's going to be a curvy linear function most likely. And actually, in the case of the Montana Department of Transportation, it seems to be asymptotic. So you can never get to where you want to be, no matter how much money you're putting into it. It approaches but never hits that magic line.
So it's a relationship between how much money you put in and what kind of level of service you get.
Exactly.
All right.
Thank you.
Yep.
Any more? Any more?
Anyone? Anyone else? We've got time for one more.
Mike? You guys team up there?
Well, I can tell you some of the other things that I heard while I was out there, and some of the questions were, A, is this geographically oriented? So if we have a whole state, do we already have commitments? Do we have people in places? Are other things more important? Also, how was the previous budget actually created? Did they just throw darts at a board, or was there actually something behind that? Or more commonly, was this just the way we've always done it? So, anyone have anything else that they would have run across? Politics, yes. So as we find, there is never a poor road in front of a senator's house. So
let me take that super quickly here. So recently, I've seen some papers at TLB and things like that about fairness and equity. Fairness and equity. Is that a real objective, is to be fair across your different districts and fair across your different political? Exactly. No, yeah, I mean fair in the distribution so that it looks pretty equitable, as opposed to just driving it by condition, just driving it by anything else.
They base a lot of their funding figures in the state based on the district they represent. Every district will get a piece of the fund.
Yeah, I'm thinking from your side on the folks who are actually handing out the money. Is that a consideration? I mean, they are obviously looking after their own things and getting as much of the pie as possible, but when the final allocations are made, is there some part of the decision made on the basis of being fair to everyone and trying to give everyone, at least something?
So guys, I think we've run out of time. So if you have any future questions, come on up and talk to us. Otherwise, thank you very much for your time.